Let's focus in on the Edelweiss ET lead indicator index and the reading for the month of January. Discuss that as well as further macros of the economy in more detail with Nishal Maheshwari, EVP Research at Edelweiss Securities, who now joins in on the show. Nishal, thanks very much for being with us. To start off with, the reading from January has come in at 98 as compared to 99 for December. Now, given that it's been moving in a broad range of 95 to 105 for the past 2 to 3 quarters, do you think that this points towards a prolonged bottoming out of economic activity?
Yeah, it does seem to be that it is sort of a bottoming out exercise basically which is happening. None of the lead indicators is yet indicating to an uptake. But definitely I think 98, 104 on the upside we've seen in the last 3-4 quarters. 3-4 months. I think that is clearly indicating that bottoming out is happening in the economy.
Nishal, you've indicated that cement will remain a drag, but CV production comes to rescue. So for how long do you think fundamentals of the cement sector will remain weak?
Nikunj, what we do in this lead indicator is we take a certain lead periods. So this may not be the immediate last month or the last quarter, but it may be 6 to 9 months lead indicator which we take into consideration. So during that period, which would be maybe 3 or 6 months back basically in this case, would have been the cement production may not have been very strong. Similarly, the CV cycle also, we have not seen that CV cycle is doing very well. So these are the two indicators which have been dragging it down. But one of the indicators which has been pushing it up is the good agriculture production, which has been seen during that period.
Now, Nishal, as per the report, you've also mentioned that the government is gradually undertaking steps to revive the business confidence and the investment cycle at the same time, and you also have the inflationary pressures which seem to be receding. Do you think this means that we can see a sustainable recovery and growth for the Indian economy next year?
I definitely hope so, and I'm keeping my fingers crossed on that. But definitely we are seeing signs. If you look at some of the steps which the government has taken in the last 3-4 months have been quite encouraging. Obviously, I think further steps need to be taken, but one thing which is becoming very, very apparent is that the Congress party and the government are totally in sync as far as the reforms are concerned. And if yesterday's news is to be believed, that further diesel price increase is going to happen over a longer period, but in short spurts of 1 rupee each month, I think that's going to be very, very positive for the economy. So I think government is very, very serious about controlling the fiscal part of it, which is very good, because if you are able to manage the fiscal at 5.3, which the government has indicated, even the inflation will start coming off. So that is quite positive. We are pretty hopeful. Our next year target is around 6.4% on the GDP compared to around 5.7% in the current year.
Oh yes, subsidy and that leakage is a huge problem. So the minute you fix the subsidy, your macro will be taken care of, and that automatically will take care of your rupee as well. Nishal, so since your lead indicator study is indicating that the real economic recovery is still a distance away, do you think markets are running ahead of themselves?
Nikon, historically it has always happened. In anticipation, markets start doing well. Now, obviously, market has reached a level where I think some of the people would like to see these the hope getting converted into numbers. And I'm pretty hopeful that the current quarter and the next quarter would be better than the last quarter, especially on the GDP side, as well as again, another positive basically is that the interest rate cut is going to start happening in the month of Jan. So that's going to revive especially the SME sector and the construction and the real estate sector. So demand is going to once again start coming back to the economy. So I think numbers will start getting delivered, possibly from next quarter onwards.
More than FDI in retail or passage of the banking amendment bill, do you think it is diesel and kerosene price hike which really could be the big game-changing reform for 2013?
Totally agree with you, Nikunj, on that, because I think fiscal is what everybody is really worried about. So what you're talking just now also is that there is a possibility of downgrade, and most of these agencies are only focusing on 2 or 3 items on the macros: your twin deficits and your inflation. And each of them is sort of interrelated. So if you are able to improve your or bring down your subsidies, your fiscal improves. Your fiscal improves, then your inflation improves, and as your inflation and the fiscal improves, basically your economy starts doing well and you start getting more FDI. So your current account deficit improves. So I think these are all very interlinked, and if the government is able to pull this off, I think that could be a very major step.
And Nishal, a word on the rupee then. Where do you see it headed against the US dollar? Because there is a consensus that as long as the current account deficit worries remain, and as well as the fiscal deficit, that there will be a weakening bias for the rupee.
If you look at consensus, I think most of the people do expect rupee to appreciate in FY14. Now, unless people go out and change their views on that, I believe that rupee should appreciate from on average around 54 rupees in the current year to 52 rupees in the next year.
Nishal, let's map the broader market trend for 2012. Now, 2012 for sure has been a rewarding year for investors, but many naysayers are still arguing that the reason why 2012 numbers are looking strong is because of the base effect and the fact that 2011 was nothing short of a semi-disaster. So 2012 is nothing special. It is only because we had a bad performance in 2011 these numbers are looking slightly smart.
If you're Nikunj, I believe you're talking about the corporate numbers, but
no,
if you look at the consensus also.
I'm talking about the Sensex absolute return. Yes.
Yeah.
It's Sensex is up 25%
so if
this
you
year.
Look at,
yeah, go ahead.
Yes, I take your point. What I'm saying here is even in FY14, if you really look at it, the consensus is staying 13 to 14% growth in earnings. Now, I believe most of these earnings will get delivered. So around 1400 rupees is a consensus call. I believe most of the downgrades have already happened. Mind you, the downgrades have happened from 1470 rupees at the beginning of the year to around 1410 rupees right now. So there has been a fair amount of downgrades. I do not see downgrades happening further, because one thing what is emerging now is though the top line has been receding, but your bottom line has been flat for last 3 quarters. So your PBT margins have been continuously at the same level of around 14.5%. Whereas your top line, which was growing at around 23%, has dropped to around 13% now. So I'm saying people are very clearly focused on to their profitability margin. So I believe as the economy revives, interest rate cut happens, I think this 1400 rupees number of Sensex earning for FY13 is going to get FY14 is going to get delivered, and I believe there is a reasonable upside from these levels in the market.
And apart from that, Nishal, if you could walk us through the sectors which you are likely to see outperformance, because brokerage polls clearly indicate that banking is going to be the front runner. Is that a sector that you would also concur with? And where do you see potential dark horses, say the media sector? Are you going to see some upside there as well?
I think obviously the sectors which are going to do well, I think 2 themes are going to play out pretty well in this year. One is moving away from quality to growth. I think that is going to be a broad theme across the market. If you really look at it, last year, though Sensex returned 25%, but it was very, very skewed. It was totally skewed towards the quality companies. Lever and ITCs of this world performed dramatically well. I think that is going to change in the current year. People are going to give more weightage, more discount to for growth, and I believe the growth is going to be there in obviously banking, which is a sector we are also overweight, along with capital goods, autos, real estate. So some of the clearly rate sensitives are going to do pretty well in this current year, is what we believe.
Nishal Maheshwari, appreciate your time and thank you for your robust and solid insights.